Well, good morning, everybody. Welcome to
Morning,
another
Neil.
edition of LAFPN. We have a very big panel today and a lot of topics to cover. So what I'm going to ask you to do is if you have questions, and I'm sure there'll be many, um, to post them in the chat box and I will monitor it. And Larry Bloom is going to help in moderating today's event. Um, just so you know, I want to welcome Lisa Duran. I think she's here, who is our latest member of LAFPN. We encourage you all to be members so that we can put on great programs on a consistent basis. We have a website, lafpn.org, where you can register. And again, we hold these meetings every 2 weeks. We try and bring financial topics that are relevant to all fields of insurance, legal, accounting, and mortgages that are relevant to all of our businesses. So, and our board consists of experts in various areas, including payroll, including business valuation with Phil, mortgages with Tim, and so we try and address all topics as a team. As a member, there's additional member benefits of being introduced to anybody you would like to be introduced to on a professional level with our group. So without much further saying, oh, and one other announcement I do want to make. I am going to be on a radio show for 13 weeks. I'm going to be hosting the main, what did I call it? The main code for financial success. If anybody would like to be involved, let me know. I'm open, especially to LAPN members that want to discuss various topics on the program. So without any further ado, I want to introduce you first to Tim Kennedy, who has helped put together this meeting, and he's going to introduce the speakers. And then Tim, you'll turn it over to Larry.
Sure. Thank you, Neil. Thank you very much. And thank you, everybody, for attending. Again, my name is Tim Kennedy. I'm on the board of the Long Island Accountants Financial Planner Network. And thank you for attending. So we got a great meeting today. I got good news and bad news, right? The good news is we got 3 panelists, professionals in their field for 20, 30, 40 plus years. The bad news is we only have an hour to cover all that information. We got to move along pretty quick and we'll go from there. So today we want to talk a lot about the housing economy and what the trends are moving forward. So what I want to do now is introduce the panelists today. So if each one of you could just introduce yourself, say hello, a quick introduction, and we'll go from there. So the first guest or panelist is Stephen A. Milner, a dear friend of mine. Not only is a dear friend of mine, but he signs my paychecks. So he's got to be very dear to me. But he's been in the mortgage industry for 4 decades. More importantly, he's been with U.S. Mortgage Corporation, CEO and founder, for 27 years. He's also the president of the New York Mortgage Bankers Association. And that's it, right? That's, well, we can go on and on, but cut it off at there. The next panelist is Todd Miranda. Todd is a realtor, owner, broker in Nassau County. Also been the president of the Long Island Board of Realtors. And then the last guest is Ray DiPresso, People's Bank. Ray has been in the financial field for 30 plus years and is a specialist when it comes to commercial lending. So Stephen, if you don't mind, just take 30 seconds, introduce yourself.
Thank you very much, Tim. And thank you, Neil, for having me sit in on the panel today. And I look forward to dialogue and any questions and Q&A after that. But again, my name is Stephen A. Milner. I'm the founder and CEO of U.S. Mortgage Corporation. We're located in Melville, and we're a licensed mortgage banker, licensed in 48 states throughout the country. And we strictly do retail origination, closing, funding, and we are also a servicer quite with Fannie Mae and Freddie Mac. So we service a lot of our own loans. And as Tim said, you know, I started this company on February 17th, 1994, but I've been in the mortgage business since 1980. So, and that's a story in and of itself, but I look forward to the dialogue here. And, you know, and Tim, thank you again for that introduction. And thank you again, Neil.
Thank you. Todd, 30 seconds, just to introduce yourself.
Good morning, guys. Pleasure to be here. Thank you for having me. My name's Todd Miranda, the CEO of Todd, Eliott Real Estate. Born and bred right here, Long Island. Amazing place to grow up. I grew up actually in Merrick, New York. director with the New York State Association of Realtors, as well as a director with the Nassau chapter of the Long Island Board of Realtors. So we're just, it's a great time to be a realtor. Really blessed to be. We're very busy. It's a very busy season. So really blessed to be here and glad to chip in here and give some dialogue, as Steve said.
And Ray DiPresso from People's Bank.
Thanks, Tim. Thanks, Neil, for inviting me. Ray DiPresso, People's United Bank, commercial lending. I deal with commercial clients looking to borrow between $250 to $5 million on commercial products, be it real estate, lines of credit, equipment purchases, and as Tim said, 30 years plus in the business. Thank you.
All right,
And I
thanks,
have
guys.
to say, just kudos to Ray. He's been very instrumental for a lot of businesses that I know in helping them get their PPA loans, and is one of the really friendly banks in that area. So thank you, Ray, for all the efforts you did in helping our clients.
Thank you. Thank you, Neil, Ray, Stephen, and Todd. Now what I'm going to do, I'm going to turn it over to Larry. Larry's going to continue to moderate and ask some questions, and then we'll open up questioning to everybody that's on the call. All right, Larry, where are you?
I'm right here. Thank you.
There you go. Oh, you're right
Tim.
next to me. Good.
There you go. In Hollywood Squares here. Good morning, everybody. Good to see everybody on this morning. We got a lot of different directions we could go in, and I know we want to get it in within the hour, so I want to give everybody their opportunity to speak and talk about their particular segment of the marketplace. I know Ray wanted to talk a little bit about PPP funding and SBA. We're going to come back to that a little at the end because we did do a full program on that. I know we want to talk about the local economy on Long Island and how maybe the whole work from home environment and the changes in New York City are impacting both commercial activity and residential activity on Long Island. So first, I'd like to focus on the commercial activity because I see that fueling and continue to fuel the growth of the housing market. So if I guess Ray and Steve could talk about what they see in terms of the commercial growth on Long Island, especially with things like Amazon looking to open up warehouses in multiple locations, distribution facilities, the ever-present talk about developing that zero wire factory in Syosset, and also how maybe the UBS arena is going to impact the economy, the local economy. So if Steve or Todd or Ray want to throw in some comments on that, and then we'll move to the residential.
Yeah, I have no problem jumping in there, Larry. Thanks. From a commercial standpoint, it's interesting, having a top-down view, especially in 2020, on what took place with the economy and the doom and gloom aspect of what was happening, quarterly, supposedly from the politicians. From a commercial standpoint, I can tell you, and Steve and Todd will tell you the same thing on the residential side. Commercial business is just roaring. It's tough to find commercial space. Commercial lending on the real estate side is very vibrant right now. Still, I have a lot of clients who recently, I must have closed 10 real estate deals last year on the commercial side, which is a good size number. And those deals range from $500,000 to $4 million on commercial lending. So the commercial market is alive and well. Attorneys that I use never slowed down last year on the commercial real estate side from the commercial lending standpoint. So the manufacturing side of it, the food industry, not so much the restaurants, but the food, wholesale bakeries, retail side of it, landscape guys, anybody who is in the construction side of it, especially on, the residential or even on the commercial side doing commercial work, all excelled last year. I had clients who had the best year ever in 2020. And I hate to say it, but it surprised me that, the year turned out as it did, considering the challenges that we went through. But a lot of the businesses that were shut down came roaring back and actually had unbelievable third and fourth quarters from looking at from my side of it and what my portfolio looks like and the experience I see that's out there.
So Ray, forgetting just from the commercial, let's say mortgage or purchasing activity, how do you feel now that the work from home environment and people fleeing New York City is going to impact the prices of commercial space on the leasing side? If you look at today's paper, or hear some of the news, JP Morgan is looking to sublease a tremendous amount of space. There were two areas they were talking about. One was by Hudson Yards, and one was, I think, 4 New York Plaza. They were looking at over 800,000 square feet to throw on the market space. So I don't know if Todd or Steve, you want to throw in something there?
I believe, thank you. I believe Manhattan is a little different market, as probably Neil will tell you. Manhattan, I think Manhattan's going to take a little bit of a beating, but the boroughs outside of Manhattan, Long Island, doing tremendous. There's not enough inventory, as probably Neil will tell you.
So where do you see commercial leasing space costs going up? How do you see, what kind of percentage? Can you predict that over the next 2 years?
I'm going to leave that to Neil to answer as a commercial broker, but I would
Right.
say outside of Manhattan, I think things are doing well.
I mean, and from so just, from a standpoint, so I'll give the appraisal aspect of things, because we get appraisals back from appraisers on commercial property, and they're all kicking in the 10 to 15% COVID discount into evaluations. I would say, on the space on the island, I would say square footage probably has come down $1 or $2 a square foot from a leasing standpoint, especially on the appraisal side. Where deals that may have had, $28 to $30 a square foot are coming in between $24 to $26 a square foot. And they're still discounting a 10 to 15% overall valuation discount because of the COVID pandemic into these reports, which is somewhat frustrating, but it is what it is. And again, the commercial is so different than the residential side, where the residential side is, probably outpacing the appraisals. On the commercial side, the price sometimes is higher than the appraisal, and sometimes we're coming in a little short. That seems to be the trend in the last 6 months, where the appraisal is coming back probably 10 to 15% shorter than what the buy price was.
Okay. As far as, attracting, let's say, younger talent to Long Island, there was obviously a fear that a lot of the young people were leaving the island because of high housing costs and maybe not so many job opportunities. Do you see now, I guess, I'm talking, to the, we have residential mortgage specialist and also residential broker on the call here with us. Do you see now that young people are starting to come back to the island because they're able to work from home and investing more money in homes, and maybe with companies such as Amazon opening up different fulfillment centers here, creating new job opportunities? Todd, what do you see on the residential side for young people coming back?
Great question. We've seen such a shift, people leaving Manhattan, sort of almost ground zero for COVID. And now with Zoom, it's so efficient to work from home and do training. So the Manhattan renters, the high renters, whether they go out into the Hamptons, clearly there's a lot of younger people. Long Island now, I think Nassau County and Valley Stream and on the cusp of Queens, this is the most aggressive marketplace, I think, in the country, frankly. You can't, you put it on the market, it's sold the next day. So, and there's a lot of young people trying to get out of the boroughs. The boroughs are not cheap neither. The boroughs are not cheap. So in Long Island, you get space in Long Island, a lot, and you could work from your home, as you said, and it's very efficient to work from home. So I do see a lot of people, young people and old people, all types of ages, moving to the island. The island is in major, major demand, huge demand, bigger than I ever seen the demand.
Right, Todd, I'll stay with you for a second because there was a question from somebody regarding possibly how home prices are going to possibly impact it if they restore the SALT deduction as a tax deduction. Obviously, if you're familiar, back at the end of 2017, going into the 2018 tax year, they limited the deductibility of state and local, not only real estate taxes, but income taxes to $10,000. Most people pay that, certainly more in terms of just their real estate taxes. How do you think that's going to impact the housing prices if they restore that deduction?
It's gonna help, but you still get to write off $10,000. if you look at Long Island, let's say your average taxes 12 to 14,000 might be average, you could say. So you're about $2,000 or $4,000 that are not deductible. You still have all your mortgage interest is tax deductible, and up to 10,000. So you're still getting significant money back. If they're gonna allow that to go and remove it, as you said, which they're talking about, that would help. Sure, of course, absolutely. But hey, we don't need any more help. This is the most aggressive buyer's market I have seen in my 32 years. They're licensed in 1988. I've never seen anything like it. Houses are going for at or above asking price, every single house almost. So you really want to be, if you are buying, you want to be aggressive and have your team ready.
Okay, thank you. Just to also throw in a comment there, because it was also a comment was made about young people returning to New York City. Again, New York City is going to take some time to build up the steam where it was. From a personal perspective, I could tell you that, housing prices in the city are a little softer. Recently, my daughter moved. My daughter was sharing a one-bedroom with a friend, and each of them were able to move to their own one-bedroom for the same price that they were paying to share a one-bedroom. They went down a little bit in the quality of the building, but the fact that they each have their own space, and 2020 was a difficult year for two women in their mid-20s living together and working together all day. So New York City residential space is a little soft right now. It's a great time if you want to get back in, both on the leasing side and the purchasing side.
Larry,
Yes,
are you're talking about, when you say New York City, the Manhattan?
Manhattan, yes.
Yeah, Manhattan's is a really very unique marketplace. And the other four boroughs are more residential. I think they're doing okay, actually. They're doing pretty good. But you're right, Manhattan clearly, as you said, is softer, and it's starting to perk up a little bit. I have some listings there, some co-ops, some of my agents, and it's starting to see some activity there, though. But you're right, definitely softer, a much more unique marketplace. That's going to be an interesting thing to watch, Manhattan, clearly.
Okay, Stephen, I'd like to get you into the mix here. If we could talk a little bit about mortgage rates, where you see them over the next 2 years, what type of products are you recommending to young people maybe purchasing their first home? And also what are mortgage companies looking for in terms of criteria, in terms of what percentages of their income between mortgage and also total debt?
Yes, Larry, if I can add also on a comment as it relates to the exodus from the inner cities. Being licensed throughout the country, we have offices everywhere, and we've seen, the commonality I've seen is that there is a migration out of the inner cities to the suburbs, and that is also, I've seen it here as well on Long Island, and that goes to your first question. But there are many people who have left the suburbs, the boroughs of New York, came out to Long Island, especially in the advent of COVID and people working remotely. They can no longer afford an apartment in a city that's even $1 million or $2 million with 2 bedrooms, 2 baths. They now need 4 bedrooms, 4 baths, or whatever it is. The kids are home. So I see that to be a commonality throughout the country, quite frankly. And I see that continuing to occur. I don't see people returning to the office, which is another topic in and of itself. More and more, and that of course has an impact on the commercial leasing business. But myself here, I have about 150 people here in my Melville office, and maybe 7 people have returned to the office full time. So people have embraced working remotely, which requires that they have a bigger home, and that commonality is occurring throughout the country. And it's no difference here. I don't see any difference here on Long Island, but that certainly has caused an increase in the purchase market. We specialize in the purchase market throughout the country, and as far as getting back to your other question, as far as rates, last year, the 10-year, about a year ago, was 0.52. Today, it's about 1% higher. Now it's about 1.45, 1.48. today, I think it is. And a 30-year fixed, which is probably 95% of the business that we do, is always about 1.7 to about 1.9 above the 10-year. So if the 10-year today is say 1.5 roughly, you would add 7 to that, let's say, and you would get about 3%. So rates are still in the range for a 30-year fixed of 2 3/4 to about 3 1/4. It's still, to me, free money, coming from my culture, being in the business since 1980, when rates were 21% on a fixed rate and 19% on an adjustable. And people still believed in the fulfillment of the American dream of home ownership. And they're doing it. And I see rates staying at what they are right now. I see the 10-year maybe going to 160. It'll range. I think it'll float between 130 to 160 over the next 4 or 5 months, but I think we'll settle in at that. Just as a point of education, when the federal government, the Federal Reserve, stimulates the economy because the economy is weak, that means that they're buying bonds. So that increases the demand on bonds, and simple demand and supply ratio. When the demand for something increases, the price goes up, right? So the demand has increased tremendously, which is what was started last year, almost a year ago, to be quite frank. And since the price goes up on bonds, that forces the yield down. It's inversely proportional. So that's why rates came down, and they will continue to come down, because I think the Federal Reserve, Mr. Powell, is going to continue to stimulate the economy. The economy still needs help. There's still a great deal of unemployment. And I think rates will stabilize and continue for a 30-year fix in the range of 2 3/4 to 3 1/4. I mean, I just did a 15-year loan the other day, but at 2 1/4. I mean, the rate environment is still very attractive.
So what would you recommend for a young couple, let's say purchasing their first home? And look, the average time people own a home is about 7 years, or
Yeah.
keep their mortgage 7 years. Would you recommend they lock in at these historically low rates on a 30-year fixed, or would you run the risk on an adjustable type of thing? What would you recommend?
No, I would. There's very little interest in an adjustable at this point. I would always be an advocate of locking in a 30-year fixed at this point. At that rate, I mean, adjustables aren't that much lower, to be quite frank, but at least you have the stability, especially for a young couple, to know what their mortgage payments are going to be each month. So I would be an advocate of staying at, just pursuing a 30-year or even a 15-year if they feel they can afford that.
Right.
Don't forget, with a 30-year loan, if you make one extra payment per year, it'll reduce the term of the loan to 22 years. So, and I recommend they do that as well if they're disciplined enough to make that one extra payment amortized over the 12 months. So.
Absolutely. Although the other side could be at historically low rates, and as long as the market continues to roar, maybe the other side is continue to invest outside of the home. We talked about originations. What about home equities? You guys active in home equity loans? I think what we saw when people started working from home this year, 2020, and also because the pandemic couldn't go on vacation, people were investing more in their homes. Did you see a growth in the home equity market so people could fix up their homes?
Yeah, we also do, we do about 70% purchase and about 30% refinance. And when people are in the refinance arena, people are pulling cash out. We do a lot of renovation loans, where either on the purchase side or on the refinance side, where we can provide them with a renovation product that will be amortized over 30 years instead of taking out, say, a home equity loan or a construction loan at a local depository, because those rates are higher and it could be less favorable. But we have a specialized renovation department that provides financing over an amortized 30-year period for any kind of renovation they want to do. Or they can just take the cash out themselves and renovate the house the way they would like, which a lot of people are doing, again, because of COVID and because they need an extra bedroom, they need an extra bathroom, they need to convert the garage into living space, whatever the case may be. But that is a very popular product as well.
All right, thank you, Steve. I don't see any questions directly in the chat about what we are talking. Oh, let's see, hold on.
If I could just chime in 1 second, Larry, because you keep referencing young couples purchasing homes on Long Island. One of the misconceptions about purchasing a home is these days is they need 20% down to purchase, right? So on an $800,000 house, right, to come up with $160,000 is a lot of money, and young couples may not necessarily have that much money in the bank, right? So what people don't understand, that there are loan programs out there. For example, FHA, they can put down 3.5%. They could also get a seller concession, right? That could help them with the closing costs and the down payment. Stephen mentioned renovation loans. Okay, we could help young couples purchase homes that are in disrepair. And not only can they purchase that home at a cheaper price, but then we can then finance the renovation repairs to make that the house that they want or need. So that's ways that young couples today on Long Island can purchase a home on Long Island and they can afford it. We have the Sony May program, which helps with down payment assistance programs. So there's a ton of stuff out there to help these young couples stay on Long Island, work on Long Island, and raise their children on Long Island.
Well, thank you, Tim, for clarifying that. Ray, we're going to get back to you in a minute, but there was something in the chat here I want to bring up. Todd, we're going to flip this back to you. As Tim just said, we were focusing on young couples. Let's talk about boomers and seniors possibly leaving Long Island as they retire. How is that impacting the seller's market or the buyer's market? Depends which way you're looking at it. And, you know, I don't know if you have any statistics on how many people are leaving the island.
We're definitely having a mass migration. Clearly, I mean, California's going down to Texas. Tax implications are very important. Keep in mind, California and New York have some of the highest taxes in the country. Jersey's right there. So a lot of these people are going because they can work remotely. They're going to Texas. Texas is booming. Florida, New Yorkers are going all the way down. You take right down to 95. In the North Carolina is very popular, very popular. I hate to prop them up, but North Carolina, one of my people just sold right here in Levittown, New York. They sold, I think their taxes are $800 for the year in North Carolina, their property taxes. Florida, 100,000 in Florida is worth, here is worth about 125,000 in Florida income-wise. So there's major tax breaks as well as, so we're definitely seeing a mass migration down to the warmer states down south, clearly.
Oh, thank you, Todd. Ray, I'm going to put you on hold for 1 second. We wanted to hear from, let's say, a recent home purchaser and probably one of the younger persons on this call. Donnie Schulman, if you want to share your recent experience with us.
Thank you. So I was listening to what everyone was saying about Long Island and New York specifically helping with affordability programs. One of the issues I see, and this is from looking at my peer group, and I bought recently in South Merrick, and I was in a place in my career that I was able to, and I work in Garden City specifically, so I wanted to be close to where I work. But my brother, a bunch of my friends, they were all renters and they're looking to purchase, and they failed to see value in Long Island. And that seems to be one of the big issues. Yes, you could potentially get a house, but Northern New Jersey, Westchester, Connecticut, all very commutable to the city, much more value for the property there. That's one of those issues I see as a driving force. How do we bring value back to Long Island homes? Because without the SALT tax deduction, with prices skyrocketing, yes, you could get a very cheap mortgage rate, which will help the amount of house you can buy. But if you could still only afford a $400,000 or $500,000 house, you're not going to be able to find a house on Long Island, at least not a house that you could bring up a family in. So I'd love to hear some perspectives on where the value is and what New York or Long Island can do to maybe drive value back to our homes, because this is going to be a big issue for younger people trying to stay here.
I'd like to hit on that. Danielle, that's a great story. You live in a great town in Merrick. I grew up there. I played my little league at Lakeside, right off of Merrick Road. Amazing town. I just can't say enough about it. You know, home ownership is still and will continue to be the pathway to wealth in this country. So Long Island's not cheap, but the incomes are there. It's certainly better than renting. So you're paying a mortgage, whether you're renting or owning, you're paying your landlords or you're paying your own mortgage. So clearly owning a home is great. One of the biggest hindrances to home ownership nationally is down payment. The Biden administration has put forth a $640 million package called the First Down Payment Tax Credit. So to be, and that's going to be a big help for a lot of first-time buyers. With $15,000 in tax credit for down payment assistance. It's not 100% done, the program there. Then you mentioned Westchester. Clearly, one of the most affordable areas in New York State, I would say, would be the Westchester North and north of Westchester. 100%. I do a lot there, actually, right up the Metro North line. That's a very good point. You know, you can get something there for $250 still. You ain't getting $250 in Long Island. Very good point, Daniel. So I agree with you there. There is going to be an affordability issue still, clearly. So it's a very good point.
Thank you, Todd. I just want to throw in a few 2 cents on that, and then I want to shift back maybe to the commercial side if Ray's still with us, hopefully. Couple things that are going to continue to fuel the Long Island market. Number one, Long Island is much more community-based than some of the other commuting districts to the city. Number two, I think if we continue, and we will at some level continue with the work from home environment, I think people are going to be willing to spend more money on their homes because they're not spending the same money commuting to the city. And their home is also going to be the center of their life, also from a commercial standpoint, because they're working from there. Number three would be alternative routes to Manhattan if you're commuting. There's obviously been talk about the Long Island Railroad doing new tracks going into Grand Central, which will increase the value of property housing on Long Island. And of course, different water routes into Manhattan, which will make Long Island communities more valuable or stay valuable. So unless anybody has any further comments on that, is Ray still on the phone here?
I don't see him.
Dropped. Yeah, I think he dropped.
Let me see if he's in the waiting room.
See if he tried to get back in.
I
wanted to
texted him
shift back
speak,
to some of the commercial
very nice.
properties and some of the programs like the SBA 504 he wanted to talk about.
Yeah, Neil, he's coming back on now.
Okay,
Okay.
let's give him a second or two.
I just want to add to Dan's point, again, because we're licensed everywhere throughout the country. We have seen a migration of those young couples, to Dan's point, who have not been able to find their dream home, so to speak, and they have elected to move to different areas. I see it. We do loans for those people all day long, you know, and they're moving to areas where it is much more affordable, and the houses are larger. They can work remotely. Their corporate, the company they work for may be domiciled in Manhattan or in the boroughs, but because they can work remotely, they don't have any problem moving. And we see it, you know, and to purchase a home on Long Island, it's probably, what would be the average? I guess 4 bedrooms, you know, 2-bath home on Long Island is probably going to be, I don't know, $700,000-800,000, right? In a decent school district.
Certainly in Nassau County, you know, so as you go further east, a little more flexibility, but certainly in Nassau County, definitely.
Yeah. So I've been cognizant of that, and I've seen people moving to Georgia, to Texas, you know, and Florida. The Carolinas are big. People are migrating there. So I do see that could be a little problematic over the next year or two. People are electing to just relocate. Hope not, but I think that's the reality, to Dan's point, that we have to be cognizant of.
Yeah, a comment was thrown in the chat about the job market in North Carolina. They have, obviously, it's a center, a hub for a lot of research in pharmaceuticals and other industries. So a lot of young, talented people are relocating there because of that cheaper housing costs, better quality of life, and good job opportunities. Anybody know, Neil, do you know if Ray jumped back on or?
I don't see him. You know, there's a question that we talked about earlier that I kind of want to get to. And that's, we were talking about the Lake Ronkonkoma hub around the airport, but also, you know, I don't know what happened in Wyandanch. I know they were going to do a big hub as far as the railroad, and they were going to develop around there. And again, I don't know where that is. I haven't left my small area where I live in almost a year, it seems. Maybe it's a year.
Downtown Wyandanch doesn't look anything like it used to 5 years ago. They put
Okay.
up 3 large, beautiful looking apartment buildings and garage parking for the railroad station. And now, over the last 8 months or 10 months, it looks empty because no one's commuting into the city, and there's very little parking around the apartment buildings. So it looks beautiful from the distance, but it looks very vacant when you get up close. They even put an ice skating rink in the middle of the development.
Interesting.
Thanks, Phil. And actually, if you want to continue, and maybe also Todd, let's talk about, I guess, maybe some of the growth of some, like the local towns, main streets, such as Wyandanch, such as Patchogue, such as Farmingdale, what they're talking about doing in terms of Hicksville, if they ever develop the property where Sears used to be, and what they're trying to make of different areas like that.
Well, I
Ray's
think-
back on.
He's just connecting now. Why don't we let Todd finish, and then we'll switch. I want to switch it back to Ray.
Just quickly, great point. Great point, Larry. You know, it's really interesting. These towns like Patchogue, Farmingdale, had such a great revitalization. We need these restaurants to get back. As the COVID rate nationally is clearly going down, the vaccines are out. I think there's going to be a lot more confidence with going to restaurants, and restaurants are key to these local areas. People move to these local places. I walked to Patchogue. I owned a house in Patchogue 20 years ago as an investment. I went there last summer. It was a different place. I walked around. There's this meatball place and there's this place, and it was such a vibrant life. And so certainly as the restaurants are able to open up, is going to have huge value. People want to live there because they want to walk around, go to restaurant and parks and enjoy the neighborhood.
And by the way, the housing in those areas where they've built, especially in Farmingdale, they're not inexpensive apartments. They're pretty high-end pricing wise. So it's tough for young people to afford it. I'd like to jump a little bit from the residential, move back into commercial. Ray, we're going to bring you back in. Glad you found your way back to us. I think you wanted to talk about the SBA 504 opportunities.
Yeah, sure.
If you can explain what that program is, who it impacts, and how we can get involved in it in terms of, and who might.
So basically, the SBA 504 program is a partnership between the bank and the SBA. And Pursuit is our SBA 504 provider based here in Melville on Long Island. They are the originators of that 504 for any bank that's on the island. The 504 is a great way to buy a commercially owned property, as long as the purchaser is 51% going to be occupy the space, meaning it has to be an owner-occupied building. The 504 allows a client to put down only 10% of a deposit to fund the deal, whereas a typical bank deal requires 25 to 30% usually. So what happens with an SBA funding situation is the bank is a 50% lender and the SBA is a 40% lender. And the client who's buying the property on the commercial side is a 10% down payment. Right now with the CARES Act, there's a great program going on with the 504. If somebody does find the commercial building and it's going to be owned directly, owner occupied, at least 51%, the SBA is currently waiving their CDC fee, which is a 1% of the amount borrowed on the SBA side. And also after approval between now and September 30th, 3 months of free payments, which is made through the SBA directly. So a huge savings if someone's looking to purchase a commercial real estate building and it is going to be owner occupied. I did a bunch in 2019. I got one right now in the hopper. It's really a great program. The SBA is a great deal. Their current rate for a commercial property, 25-year fixed, is 2.6% for 25 years. That even beats the residential, 25-year rate at the current time. But commercial property, 25 years, 2.60 fixed for the life of the loan, fully amortizing.
That's amazing.
So it's a phenomenal deal. If someone is looking to buy a piece of commercial real estate, it's going to be owner occupied. We partner well with the SBA. The SBA does cover the bridge for us because what happens is there's always a delay in the SBA funding. So there's usually got to be a 30 to 60-day bridge loan, which the SBA will more than gladly provide the client for a 60-day interest-only situation.
That's huge.
And the other side of the fence is no New York State mortgage tax on the SBA 504 portion, which is at 1.05. So some great advantages that the program does provide, especially now with the current CARES Act in place. There is a huge savings to the client looking to purchase that kind of building.
Ray, there were two questions thrown into the chat room. One was on start to finish, how quickly can we close on a 504? And two, explain the CDC fee to us.
Yeah, so basically, the CDC fee basically is a fee back to the government for processing the loan. So they're waiving that fee, which is a 1% fee on what they're borrowing on the SBA side is. The other side, I'm sorry, what was the other part of the question, Larry? That's just slipped my mind.
Start to finish in terms of application process to closing.
So basically, what happens is the bank does their part, SBA does their part. Usually the bank will probably approve first before the SBA approves, but it's kind of works simultaneously. We can close an SBA 504 deal probably within 75 to 90 days, start to finish, from time of first meeting to time of closing. Usually after the bank funds their side, the SBA will do a bridge loan for 30 to 60 days, which will be a simultaneous closing. And then once the SBA gets funded, because they only fund twice a month, so it depends when the funding is going to take place. Once that gets funded, then the SBA loan kicks in, and they'll have two loans: one from the bank, one from the SBA. Well, now the bank's not going to match the SBA rate, of course. We're in this to make a little money, so the bank rate's not going to be as favorable as the SBA deal is. And secondly, we're not going to fix for 25 years either on the bank side. And that'll be something that will be discussed between myself as the banker and my client, and understanding what the process is.
Thank you, Ray. Again, just throw in a couple comments myself. As somebody who is an advisor to small businesses, I've always, where applicable, tried to advise my clients if they could invest in their own buildings, they control their destiny, their future, and it's a great opportunity also to build assets outside of the company business and outside of their 401k. We're going to be doing a little jumping around again. Sorry to do this based upon some questions. And also I want to come back to Stephen later about some mortgage payments, but the question was raised, and I guess maybe this is for Todd, about how the Long Island Railroad Third Rail program is impacting residential and commercial property values along the railroad lines.
Well, thank you, Larry. Clearly, that's going to be a nice boon, but there have been a lot of, there's been a little infighting on some of the municipalities there of how to get it done. So although it's going to be, I think, a very good, boon for some of these local townships, there is a little challenges there with it. Also, Larry, if you don't mind, real quickly, I'd like to thank Ray with People's Bank, because I could tell you they've done a great job during COVID with small businesses. I could tell you their SBA partnership and PPAs have been really amazing. So I just want to really mention that I've worked with them on the commercial side. They're excellent. And they've been really helpful during a great resource for the community during COVID. I apologize. Just wanted to mention that.
Great. Thank you, Todd. Stephen, I'm going to flip it back to you. Two questions, a little different. First one, talking about maybe where we were in terms of mortgages and deferral of mortgage payments and forbearance over the past year and how that's impacted and what kind of percentages of mortgages are in arrears. And the other question was about, are you going to be seeing an increase in rate swaps because rates are so low? I know they're more popular in Jersey on commercial properties where there's a lot of rate swaps, but I don't know if you want to throw in some comments regarding those two areas.
As far as forbearance rates have declined. It's maybe, I think it was as high as 8%. Now it's down to about 4%, 4.5%, I believe. And again, people who forborn, they have a number of different options. They can either take it out for 3 months, 6 months, 9 months, or 12-month forbearance. Personally, we haven't seen too much from our servicing book that we have, fortunately, but the borrowers have an option to pay back the forborne amount over the following 12 months, or they can add that amount to their the amount that was forborne onto their principal loan amount, or they can modify their loan, or they can extend the term of the loan. There's a number of different options that will keep them in the house. The government did a great job with that, quite frankly. So I think but I think we're going to see less and less people, as the economy improves, will opt for forbearance. So that was what was the second question on that?
The other question had to do with interest rate swaps.
I haven't seen too much of that right now in New York. There's a little bit of it in New Jersey, as you said, but I haven't seen too much of that going forward.
Yeah, I've seen it primarily in New Jersey. I haven't seen it really in New York, and it's on commercial properties.
Yeah.
Maybe on commercial, but
Right.
yeah. So I just think that as the economy improves, I mean, today, as far as the vaccine is concerned, I mean, they're looking at anywhere from April to June where the vaccine will be available, and people will return to work, hopefully, and I think a lot of people who especially were in the service industries, like the restaurant industries or the entertainment industries, they're looking for different opportunities. They're looking to change their careers. I know here in U.S. Mortgage, we have an apprenticeship program. A lot of people have approached me about learning the mortgage banking business, and because they just don't want to be put in a position like this again. And I think that will enhance the economy, and once people return to work, you'll see less and less people opting for forbearance. You still have to pay back the money that you deferred, if you will. So people are concerned about that.
Okay, thank you, Stephen. I have one more question in the chat, and then what I want to do with our remaining time is give each of the three panelists like a minute or 2 minutes to just give us a prediction or some comments on what they see in the next 18 months, let's say. But the question I'll throw to Todd, and you could start out with after that, you could talk about what your prediction is, and this kind of relates to it, is do you believe residential property values will continue to rise in 2021, or has the ceiling been hit?
You have to unmute yourself.
Oh, whoops. Thank you. Clearly, Larry, there is no stop here. This is going to continue. As Steve said, the rates are incredible. That's not going to change for a while. There's just not enough inventory to satisfy all the demand. So I see this spring, this wintertime, people are still bidding over us. So we're very busy. I know Steve is, I know I am. I do a lot of work with Steve. He's probably one of the best lenders and the top lending CEO in the country, in my opinion, frankly. But I don't see any slowdown at all. There's just not enough inventory. That's just really, what I could tell you is if you're a buyer, be prepared. Have your home inspector ready the next day, frankly. If you take a week to get your inspector and your team ready, you might lose out on that deal. That's what's going on here. Have a good team, and I think it's going to be a very busy season coming right up down the block again.
Actually, Todd, here's a question for you that just popped in my head. In terms of inventory and available inventory, how do you see the growth of these communities, the planned communities for 55 and older, impacting the ability for houses to be transferred to, let's say, the next generation of people as the older segment moves into these planned communities?
I mean, it's a good question. They have these planned communities now, whether you go to, like you said, Farmingdale, or all these cities have these planned, they're not cheap, as you said. They're not cheap, but as the older generation moves onward, they are changing some of the workings and the zoning of these that will allow for some of the younger people to move in. That is happening. That's a very good point, Larry.
Thank you. Ray, we're going to switch it over to you. Why don't you give us what you think for the next 18 months is going to take place here in Long Island?
I just think we're going to continue to see, you know, robust growth. I mean, from a commercial lending standpoint, I see, again, my clients or clients who are coming to me looking to make purchases on buildings, looking to borrow money, establishing working lines of credit. I see things being robust, even though, as Stephen said before, the 10-year treasury is up to about 1.46. You know, the commercial market on the rate side is super cheap still. Prime is at 3.25. You know, we're lending lines of credit between 3 3/4 to 4 1/4 on interest only lines. You know, so there's a lot of working capital available. I think the banks were nervous. I'd say 9-10 months ago, we were shaking in our shorts thinking, oh my God, the world's going to end. We had, and getting back to the forbearance thing on the commercial side, we had 100 forbearances in commercial on the island in 2020. Guess how many people requested a second forbearance? 4 out of the original 100. So the commercial mortgages are being paid. They're surviving. They're functioning. And I think, as we said before, and Todd said it before, in regards to the restaurant business, once that opens up fully, you know, everyone's pent up. Everyone's tired of being home. You know, they're tired of walking through the parks at Blydenburg and Comsit and wherever else they're walking around. They want to go someplace else. So I think Long Island's going to see an influx of tourism coming in, especially out east in the Hamptons. And I think, you know, business, again, as someone said before, I think Stephen said that the out east never stopped this year. You know, there are places that stayed open the whole season and did very well because all of Manhattan went out east and they ain't leaving. So I think the economy of Long Island is going to be robust. Again, I'm born and raised here. I love the island. I ain't leaving. I think it's a great place to be and live. And, you know, that's just my sentiment.
Thank you, Ray. I'm going to give Stephen the last word, and then we're going to flip it back to Neil for some closing comments and talk about LAFPN. So Stephen, you're the last.
Well, I mean, the main principle in business is demand versus supply, right? And that impacts everyone's business who's on this call. When demand increases, prices go up. And thusly, in my opinion, on Long Island and everywhere in the country, quite frankly, demand will continue to increase. I see it everywhere. And what happens when demand increases, prices will continue to grow. And that's going to require that people return to normalcy, return to work. And personally, I would like to see more on the government side, on the New York State government side, where people will feel more comfortable, if you will, about being in a public setting, feeling comfortable about going to a restaurant, going to a bar, you know, and just being able to go to a movie theater, go with their children to different places. You know, I think we've reached that point in our as far as it relates to COVID, where we can feel comfortable in social gatherings, and I think you're going to see more of that. And if we do see more of that, we're going to see more demand for services as well as housing, whether it be commercial or residential. And I see in the next 2 years, quite frankly, values continue to escalate and continue to improve, and especially if the economy continues to improve. The demand will continue to rise, and that will maintain or increase purchase prices.
Okay, thank you, Steve.
Throughout Long Island.
Thank you, Stephen. Neil, you want to take it?
You know, I have to say, this was the most refreshing hour I've heard in such a long time. I'm so sick of gloom and doom the past year. And isn't it nice to hear positive things?
Yes,
The economy's
sir.
moving,
Yes.
that we're back to work, we're making money. This is good stuff. This is great. Okay, Larry, you did a fantastic job of moderating. Do appreciate. And again, I encourage everybody to join lifpn.org to continue these discussions. This all interplays with everything we do in the financial world, mortgage rates, insurance rates, taxes. I learned a lot about that program that what Peoples is doing with the 504C SBA. It's great for our clients to know this kind of stuff and help them. So we do appreciate it very much. And again, I am going to have a radio show if anybody's interested in participating. I'm happy to discuss it. So thanks again. We'll see you in 2 weeks. We're going to do some case studies that are going to interrelate to everything that we do. And again, thank you to the speakers and thank you all, and look forward to having a great week.
Thank
Have a
you.
Sun's
good
coming
day,
in.
everybody.
Thank you,
Appreciate
Neil.
it.
Thank you all. Thank you, panel, for participating. Thank you.
Thanks,
You're very
everybody.
welcome.
Thank
Ray,
you.
send me some information.
Thank you.
Take care all.
Hey, Neil, a question for you.
Yes.
It's Russell. Any relation to Miriam Helmelstein?
My mother,
Your mother's Miriam?
she was, yes. She passed a while ago. Is there another Miriam Himmelstein?
There's
That
another
you know?
Miriam Helmelstein, yeah.
Where does she live?
She used to live in Merrick because I just bought the home from her.
Okay. I have a book of every Himmelstein family in the world. And I will track it
Okay.
and let you know.
Yeah.
Somebody you know closely, or?
No, it's actually my dad's girlfriend now lives around the block, and that's how I found this house before it came on the market.
Oh, that's crazy.
Yeah, I moved in. We bought it January of last year, so right before the crazy boom. Moved
Oh,
in
neat.
February.
Yeah,
Yeah.
no, it's I didn't do it, but somebody put together these 2 volumes of all the Himmelsteins around the world, going all the way back to, I think, the 1400s.
Wow. So there's that many that there's 2 volumes?
This guy did a lot of research, and
Wow.
it was his wife, and he did so, and it's pretty cool because we're not all definitely related,
Yeah.
but we have similar family ties because of where we came from. So Himmelstein means heavenstone.
Okay.
And was really in Ukraine. It was in Ukraine right next to Germany. And Himmelstein means heavenstone. And there's all these rocks that used to shine on this mountain. They called them the heavenstones. And unfortunately, we lived at the bottom, not at the top.
Yeah.
But we've emanated out throughout the world,
Oh, wow.
So, and every time you bump into a Himmelstein, they're always curious because they want to know. And
Yep.
when I started in this business, I started in Connecticut. And I gave somebody my card. It said Himmelstein and Associates. And they said, across the street, I met Mom. Remember Mom Pa Kettle? Do you know Mom Pa Kettle? It was
No,
a
where's
TV
that?
show about these people who had a farm and they were still operating in the 50s. Well, I
Russell's
met
a
Mom
little
Pa
younger
Kettle
than you, Neil.
Himmelstein up in Hebron, Connecticut.
Oh, wow.
Yes,
That's
it
a
was
cool
very
story.
interesting. Yeah, crazy stuff.
That's a
So
nice.
I'm happy to
story,
look that up, though. My mother was Miriam Himmelstein.
Neil, that's a
That's-
nice story.
That's
Yeah.
a very
You
cool
know-
story. Yeah, look that up for me. That'd be great.
If I
Yeah,
could
I'll
just,
definitely do that.
if I could
I
just
really
interject,
appreciate today. Thank you, Larry. Thanks,
Yeah.
guys.
My
Thank
pleasure.
you, guys.
Steve, you wanted to
Nice
say
to meet
something,
you.
Steve?
yeah, I just, a very good friend of mine is on the call, Robert, Bob Dealman. He is an account executive for Arch Mortgage Insurance.
Oh,
And
terrific.
he has, I'm sorry to put you on the spot, Bob, but maybe you can give some impact, some opinion as to where you see the market going, how the MI business has been doing over the last couple of years, and where you see it going forward. Real quick, something anecdotal, because I thank you for joining, but I thought you'd have some comment on what's been going on and where you see it going. I don't know if you're
He's connecting.
Connecting
It's
to the
okay.
audio right now, so give him a second.
Okay.
Oh, no audio.
Good thing we're going into extra innings now.
We can't hear you, Rob.
Yeah, it's still on mute, Bob.
Still connecting.
Yeah, no go on the audio.
While we're waiting, hey, a lot of merit connection, a lot of merit people here today, huh?
Yes.
The Moroccans.
Yes.
That's funny.
Anyway, you know, Bob's having some technology difficulty, but to Tim Kennedy's point, we do a lot of loans at 97% loan to value. Tremendous amount of business. 3%
Interesting.
down, 3.5% down, and the mortgage insurance companies, of which Bob represents one of them, is a great partner in facilitating that insurance product. And that certainly is very helpful to borrowers who only want to put 3% down on a $500,000 house. So you're buying a $700,000 house, we can do it with 3% down. So
That's incredible.
Great.
they have to
Thank
still
you.
be able to afford it. You know, there's still could be issues relative to their debt to income ratio and their qualifications, but we do those all day long. But you need a good insurance company who will take it to the finish line, and Arch is outstanding.
That's great. Maybe we can
Bob,
meet on a
can you-
separate note, Rob.
I guess next time we'll get Robert on there.
There you go.
Sounds terrific.
All right, guys, have a great
Thanks,
day.
guys.
as
Thanks
well.
again.
Be
Thank
safe.
you.
Thank you.
Thank
Have
you.
a great day.
Take care.
Bye-bye.
Ray, send me some information.
Definitely.
Me?
Yeah, Ray.
All right, you got it.
Yeah,
Bye.
man.